Good morning, students. I am Dr.V.VIJI, Associate Professor, Department of Economics, A.D.M.COLLEGE, Nagapattinam. Today we are going to see economics of risk and uncertainty. Now we have to see the meaning of uncertainty. Uncertainty is a fundamental fact of human life. So, all economic transactions involve an element of risk. Wherever there is uncertainty, there is risk. It is essential to know the difference between the risk and uncertainty. Risk is a situation where the possibility of happening or not happening of an event can be quantified and measured. Risk takers is aware of all possible happenings and known as the probability of one occurring in real life. There is uncertainty and many goods and services involve risk such as investments in share and stocks, insurance and gambling. Theory was refined by Friedman and Savage by applying it to risk from buying insurance, and further by Markowitz in order to understand individual attitudes towards risk. We study risk preference on the part of an individual. Risk preference, attitudes towards risk. An individual's attitudes towards risk depend upon his choice and the returns he expects to obtain from them. Generally, higher returns are expected from higher risk. Any decision on the part of an individual reflects his attitude or preference from risk, and these preferences differ from individual to individual. Suppose persons are willing to take risk, others are averse to risk, and still others are risk neutral. Persons who undertake risk expect a reward in the form of higher returns, profits, or money income or utility. Risk neutral. A risk neutral is a person who will play the game if the odds acts favorable to him. He will not play if the odds are unfavorable and will be indifferent about playing a fair game. Risk loving. A person is risk loving if he is prepared to play the game even when the odds are unfavorable to him. He will play the game even if the chance of winning is ₹1,000 against losing ₹10,000. Risk averse. A risk averse person will not play the game if the odds are unfavorable to him, but he may play if the odds are sufficiently favorable to him. He will not be prepared to play even a fair game. Risk preference and expected utility. Most of the people but are played games in a casino or at a race because they want to earn more money, which gives them satisfaction. Economists measure satisfaction in terms of utility. They explain risk preference by three types of individuals by associating with utility. This theory is based on some principles or assumptions. This analysis is assumes an individual's satisfaction is associated with money. Utility is a measure of his satisfaction. The individual has certain amount of money, plays the coin tossing game, knows all the possibilities, choices are certain, and an individual wants to maximize expected utility. That is, he chooses the highest expected utility or payoff. Given these assumptions, consider a gamble when a coin is tossed and payment is made to a player. Suppose a person has ₹10,000 and he offers to bet ₹5,000 on the toss of coin. If a heads is tossed, he earned ₹5,000. And if a tail occurs, he lost ₹5,000. If he doesn't choose to bet, he will have ₹10,000 with certainty. Risk neutral. The risk neutral case is illustrated in figure 1, where money in rupees is taken on the horizontal axis. and utility associated with each payoff is shown on the vertical axis. The expected utility with certain prospects of having rupees 10,000, that is 16. The expected utility with uncertain prospects is expected utility is equal to 0.5 within bracket 8 plus 0.5 within bracket 24 is equal to 4 plus 12. Therefore, the expected utility is 16. We find that in the risk neutral case of game, utility associated with certain prospects equals the utility with its uncertain prospects. That is, 16 is equal to 16. Here, both have equal expected monetary values as explained in the above example of a coin tossing. Here we have to take the diagrammatical explanation of this risk neutral. Here we have to draw the total utility curve. Here the utility is 8 units, the returns is 5,000 units. When the utility, the risk utility is increased from 8 to 16. Here the utility is doubled from 8 to 16. Here the returns also doubled from 5,000 to 10,000. Again the utility is increased from 16 to 24. In that situation, the income returns also increased from 10,000 to 15,000. Here the utility and income, it is gradually or the ratio is equally increased from the utility and income. This is called risk neutral. Some of the individuals, they have to like this situation, risk neutral. Then somebody or some persons, they are very much loving the risk. Here figure 2 depicts a risk loving person whose total utility curve has an increasing slope that shows increasing marginal utility of income. The expected utility with the certain prospects of rupees 10,000 is 10. The expected utility with uncertain prospects is the expected utility is equal to 0.5 within bracket 4 plus 0.5 within bracket 20. Therefore, it is equal to 2 plus 10, therefore 12. When the utility level with outcome of rupees 5,000 is 4 and rupees 15,000 is 20. Here we have to see the diagrammatical explanation of risk loving. Here the total utility curve like this. Here the utility of risk is 4 units, the return is 5,000. Then the total utility is increased more than double, that is 4 to 10. Here the returns is 10,000. Whether here the risk is more compared to the returns. The risk and income ratio, here the risk ratio is more than doubled, but the income is only doubled. So in this situation, some of the individuals, they are very much interested to love the risk. In that situation, they are enter into this risk. This expected utility for the uncertain prospects 12 is greater than the expected utility for the certain prospects within bracket 10. Therefore, 12 is greater than 10. Therefore, the person would prefer the gambling with the uncertain prospects with the expected utility of 12 to that with certain prospects with the utility of 10. This gamble with the utility level 12 on the total utility curve is associated with rupees 12,000. The risk lover would therefore take the risk of gambling above his certain prospects rupees 10,000 up to rupees 2,000. Therefore, it is equal to 12,000 minus 10,000. The case of a risk averse person is illustrated in figure 3, where the slope of the total utility curve shows diminishing marginal utility of income. As income increases from rupees 5,000 to 10,000 to rupees 15,000, the marginal utility diminishes from 10 to 8. The expected utility associated with certain prospects of rupees 10,000 is 18. The expected utility with uncertain prospect is 16. When the utility level with outcome of rupees 5. 0 is 10 and rupees 15,000 as 22 is shown below. The expected utility is equal to 0.5 within bracket 10 plus 0.5 within bracket 22. Therefore, 5 plus 11. Therefore, the expected utility is equal to 16. Risk averse. In this case, the expected utility with uncertain prospect 16 is few than the utility for the certain prospects 18. That is, 16 is less than 18. The risk averse person would prefer the certain prospects with higher utility to the uncertain prospects with lower utility. Thus, he would avoid the bet and would be willing to pay rupees 1,500. The difference between certain income of rupees 10,000 and uncertain income of rupees 8,500. This difference is called the risk premium. To determine the size of risk premium, we carry our example further. The explain it is figure 3. Join points A and C on the total utility curve with a line that relates to income utility levels of rupees 5,000 with 10 utility and 15,000 with 22 utility. Notice in the figure that rupees 8,500 would also given an expected utility of 16 with certainty at point B on the total utility curve. This amount is the certainty equivalent of the gamble on the part of the risk averse. Here we have to take the explanation of diagrammatically risk averse. Here x-axis represents income, y-axis represents the utility. Here the utility is 10, the returns of income is 5,000. Then the returns, the utility is doubled, more than doubled, that is 22. The returns is 15,000. Returns is 15,000. Here the returns is higher compared to the risk. Returns is greater compared to the risk. Whether you have to take an example of the equilibrium B, here the utility is 16, not doubled, it is less than doubled, but the returns is 10,000. Even though some of the individuals, they don't like to take risk. This is also one more behavior, individual behavior of taking risk. But he would prefer to have the certain income of rupees 10,000 with the same utility of 16 as shown by drawing a horizontal line from B to D on the AC line. Thus, the risk premium is the BD segment, which is rupees 1,500. The difference between certain income of rupees 10,000 and uncertain income of rupees 8,500 at the same expected utility. Leaving aside risk lovers, the majority of persons are risk averse who face risky situation. Many measures are suggested that reduce or transfer risk across individuals. It is explained as under. First one is insurance. Here we have to see how to tackle the risk, how to face the risk, how to reduce the risk. The first one is insurance. Individuals transfer risk by buying insurance against financial loss under a variety of risks, such as death, injury, theft, fire, etc. Insurance companies compensate their policyholders in the event of loss at a price in the form of premium paid to the company. Risk-averse individuals buy insurance by paying premium to reduce risk. Consider a person who decides to insure his house against destruction by fire. If the value of the house is rupees 20 lakhs and the probability of its burning down in a year is 1/400, that is 400, then the expected value of the loss is rupees 5,000. There are two options available to him. if he doesn't buy insurance and there is no fire, the value of the house remains intact, rupees 20 lakhs. And in case of fire, it is 0. Second, if he buys insurance and pay rupees 5,000 as premium to the company, the value of the house is, in case of no fire, at the end of the year, rupees 20,000 minus 5,000. Here, the rupees 19 lakhs 95,000. In case the house is destroyed by fire, the insurance company will cover the risk of the house by paying rupees 20 lakhs to the owner. Thus, by diversifying into a variety of insurance, they spread risk. Similarly, an investor trading in the stock market can reduce his risk through diversification. By combining different stocks in different proportions in his market portfolio, he can reduce the expected loss from risky stocks. Second one is diversification. This is one more option to reduce the risk. Risk can be reduced by diversification. When a firm expands into new types of business, instead of concentrating on only one type, it reduces the risk. Insurance companies are profit maximizing firms. So, instead of offering only one type of insurance, they sell insurance for house, life, car, health, etc. Third one is futures market. Individuals try to reduce risk through the futures market also. The futures market usually exists in the case of agricultural goods and stocks, etc. Suppose a farmer grows rice and doesn't know whether the piece of rice after harvesting will fall or rise. He is uncertain, but his future yield and income, so he wants to insure insurance against the possibility of a low market price. To cover his future risk, he entered into a future contracts with a wholesale merchants to deliver specified quantity of rice at a specified future date for a specified price. If the expected low price is rupees 300 a bushel and the high price of rupees 400, a bushel is expected, then a fair odds delivery price is rupees 350. By signing future contract to deliver rice at this price, the farmer will be reducing his risk without sacrificing expected value. Then the last one is forward market. In a forward market, contracts are made today for delivery of goods in the future at a specified date at a price agreed today. Forward markets exist for many goods and assets such as sugar, wheat, tea, gold, silver, foreign currencies, etc. Consider a forward market for gold. Its current or today's price is rupees 5,000 per 10 grams. This is called its spot price for immediate delivery. People expect its price to be rupees 5,500 on this date next year, which is its future spot price. But there is an uncertainty that this may not be the price next year. So the person can hedge against this risk in the forward market for gold to a trader who is a speculator. Suppose he agrees to sell 1 kilo gold at the future spot price of rupees 5,300 per 10 grams to the speculator. So the seller has reduced his risk through hedging by selling his gold to the speculator at the future spot price of rupees 5,300. Even though he expects it to be rupees 5,500, thus rupees 200 is like an insurance premium. which the seller has paid to get out of the risk associated with the future spot price. If the expected future spot price next year turns out to be rupees 5,500, the speculator will earn rupees 200 per gram, which is his risk premium. Complete information. People face risk and uncertainties making decision because of incomplete information. They cannot make maximizing decision if they are not properly informed about the things they are buying and selling. So, complete information is essential to reduce the risk in buying or selling of a commodity. This can be had through advertisement of various types. Economists regarding information as a commodity which can be bought and sold. This information has a value, and the value of complete information in the difference between the expected value of a choice. When there is complete information and the expected value, when the information is complete, consider a firm which spends on advertisement, research, etc., so that the people get complete information about its commodity. Choice between insurance and gambling. There are certain risk-averse persons who spend their time reviewing their insurance coverage and engage in gambling at casinos. This appears to be consideration because this behavior suggests that people are risk-averse and risk-loving at the same time. In reality, there is no contradiction because such a behavior depends on the nature and the cost of insurance that can be bought and on the type of gambling game. Asset portfolio selection. An investor is interested not only in the safety of his assets but also in increasing the expected returns on his assets and reducing the risk of that return. This depends on the market portfolio of assets. He holds or selects a portfolio is a collection of assets or combination of several stocks such as shares, bonds, securities, treasury bills, etc., which are tradable in the stock of financial market. Now we have passed on to the conclusion. All such assets are risky because their future outcomes are uncertain. In other words, the possibility of their actual outcomes or returns may not be the same as estimated. The actual outcomes may vary from the estimates. So the risk may be considered as a chance of variation or of loss. An investment having greater chance of variation or of loss is considered as more risky than that with a lesser chance of variation. Thus, risk refers to the variability or dispersion of expected returns. Thank you.